Good morning, friends. Let's just wait for a minute or so for everyone to join in. And if some of you are blurry-eyed, red-eye, uh, you're forgiven. We all know that a lot of us have spent sleepless night, uh, either covering, analyzing, passing through all the sections. No wonder the house is filling up so quickly. Boy, when did we last have a budget with such action? It takes me to my first budget as a journalist in 2004. I joined CNBC in April 2004, and no one expected the government to fall, which it did. Mr. Vajpayee lost, and you had the UPA government come in for the first time, UPA. And Mr. Chidambaram was the finance minister, and he brought in the fringe benefit tax, I think, in the interim budget. And boy, that dominated the airwaves for quite a while. Every interview was dominated by the fringe benefit tax, and so many hypotheses on how that will work. So 20 years later, I think every 20 years we need to have such a budget which keeps reminding the public at large how important the tax fraternity is. And that is what the finance minister has done. She's given a fresh lease of life for all us tax professionals, tax reporters, observers for at least another 5 to 10 years. And if you think that the action in yesterday's budget, be it angel tax, capital gains, indexation, reassessment, buyback googly, the equalization levy doing away, you have the individual tax tweaks, then you have the Vivad Se Vishwas 2024 monetary threshold change for departmental appeals. And these are just some. This is just a flavor of what came yesterday. 80-page finance bill on direct tax amendments and substantive. These are not like the amendments that came a few years back, 100-odd amendments, but all itsy bitsy amendments. No, these are substantive amendments, a lot of which we thought or we betted before the budget speech would come in February. But the finance minister, if I had to capture the budget in just one line, the finance minister, Mrs. Nirmala Sitharaman, did bite the bullet yesterday morning. And how? It pierced through several sectors, that bullet, and we are all analyzing whether we have escaped the bullet or whether we've been wounded by the bullet. And if we've been wounded, how injurious is that wound? So how deep is the wound? So that is what we are going to analyze over the next 75 minutes with an ensemble team of experts from KNAV and A Shah. We have Uday Ved, who's the Uday Ved, senior partner KNAV India. Mr. N. Krishna, Partner Tax Regulatory and GST KNAV, Hetav Vasani, Senior Manager Global Transfer Pricing KNAV. We also have Chanchal Khandelwal from the KNAV team, and we are joined by a special guest, Parag Mehta, Partner in A Shah Associates, who will take us through some of the intricate GST provisions, and there are a few of them as well. I'll, of course, the drill is I'll hand it over to Uday Bhai. He and the KNAV team will take us through the amendments one by one, especially the key ones, and we'll be spending quite a bit of time analyzing those provisions with even possibly some case studies, and then we'll go to GST, and then we'll have a lot of time for your questions. Please do keep them coming. Post it in the Q&A box if possible, not in the chat box, and we'll try to take all of them today. There's no paucity of time. We've said that this budget deserves a lot of time. It deserves a lot of attention. And the finance minister has also doled out, yesterday, when I did the pre-budget webinar in the morning, I held out my teacup, which had Harry Potter name inscribed on it. And I said, maybe the finance minister today would fire the magic wand and say, expecto patronum. And yes, she did. She fired the magic wand, except we don't know whether it's fired in the right direction or in some cases misdirected, but the fire she did yesterday. The magic wand has been unleashed on all of us, but with not with a threat, but with a sort of what we say, a warning for all of us, saying that in 6 months' time, there will be a comprehensive review of the income tax code. Even in my dreams, I have been thinking about what will come, when the income tax code is reviewed. It's something that we journalists have been waiting for the last 20 years and hasn't happened. Finally, if it does happen in a lifetime like the GST has, then I'm sure that we'll spend the next 12 months discussing every provision of an overhauled income tax code. The income tax code, of course, dates back 63 years. On that note, I hand it over to Uday Bhai. Over to you, Uday Bhai. A warm welcome from Dallas, I believe. He is joining us from Dallas. It is 11:30 p.m. In Dallas. And Uday Bhai, I know you haven't slept for 2 nights in a row now. So thanks. Grateful for your time. Grateful to KNAV for the collaboration. Looking forward to this webinar. Over to you, Uday Bhai.
Thank you, Arun. I think you set the ball rolling as usual every time that I've spoken with you, every time when I'm part of the panel with you. So, and I'm sure unless like I haven't slept actually for last 2 nights, you're right. It's almost a night here. So are the so many people, even the participants have not slept. So I think the time worth spent doing what we did. And as you rightly said, one thing which reminds me of this government is 2015, when the late Mr. Jaitley at that point of time made that statement to say that we will reduce corporate tax rates over next 4 years. So the first time somebody gave a path. Okay, and I think it was very interesting. And the government stuck to it. Instead of 4 years, it took 4.5, 5 years. But we did see the tax rate getting reduced from 35 to 25 or 22 and 25 today, as it stands. And again, it is the Honorable Finance Minister this time made a statement that she will do the comprehensive review of the Income Tax Act over next 6 months. I think that's a much shorter period. And to make that statement means that this government actually means and has actually delivered in terms of the timeline. So in terms of implementation, which always was lacking, this side of the government every time has implemented. So we should see that if these 80 pages are to be seen, maybe you'll have a new Income Tax Act of 400 pages, God knows, or the same act may get revamped. We'll see that. I think a lot of action over next 12 months, as you rightly said. And rightly so, this is more than a 60-year-old law, right? From 22, it became 61. We are in 2024. So a lot has changed. And it has to align with the today's reality. So we already gone through the changes on the Companies Act from 56 to 2013. We have GST, which is now 7-year-old law, and we'll talk about it. Actually implemented a lot of it, with the government and the majority, 2/3 majority. It is implementing all kinds of decisions we have seen, and we will cover the 53rd meeting which has happened in terms of what are the changes came out of it. So a lot of regulatory changes have happened, and implementation is actually happening. That is more important. So the path, the roadmap, the stability, and certainty. Certainty is always a question mark. What is meant by certainty? But surely, as we see through it, and when we see the new Income Tax Act, and I've seen the global precedents, right, with the IRS code here in the US. You have the entire thousands and thousands pages of tax commentary. Whether the new change will bring that, that's one way of bringing the certainty, right? We'll see that. But focusing today on in terms of the changes which have come out of it, good budget. A lot has been said, I'm sure, since yesterday. And I'm sure most of the participants are up to the speed. So there may be some repetition. But at the cost of repetition, we'll try and do it. We'll try to make things little different, as you just rightly put in, for every important initiative or the tax change, we have tried to give it some kind of a small case study in terms of how it actually means it can work in terms of the financial numbers. So we'll try and carry it through. So with this, I'll request my colleague Hetav to share the presentation, and we can straight jump into the thing. So I think that our heading itself is path towards certainty, and reformation, which is, as I mentioned, the path which has been given since last 10 years. And we are seeing a path getting continued, which is good part. So the stability and the certainty part which comes with it. Next, please. I think Arun already said, yeah. And rather than getting into the macro proposals and everything, again, a lot has been said in economic survey, and the budget speech part A will dwell straight into the key tax proposals, both direct tax and indirect tax. So if one looks at the entire budget overview, significant part, 58% of the corporate tax comes from the new corporate tax regime, and more than two-thirds comes from the new tax regime. It means whatever government has put in, if you looked at individual tax regime 4 years back, it didn't work out. But this time, a lot of thing has come from the new regime in terms of simplification. The 15% tax or 22% MAT gone, without MAT. That part, we've seen that people have taken it. And as I mentioned, there would be a comprehensive review of the Income Tax Act. We'll see in what shape and thing come in, whether a new direct tax code will come in or it will be part of the Income Tax Act, which essentially will, I think Finance Minister did say that it will be lucid and easy to read. We will see how it, whenever the government and the regulator wants to make it easy, we all professionals and consultants try and make it as complex as possible. But yes, the whole purpose would be to make it simple. Ease of doing business, which is, again, it goes with that. Reducing of tax litigation, I think that's going to be very important. Some part of it has come in terms of the Vivad to Viswat scheme. Again, the second version 2.0 this time, which has been put in. And finally, it should lead to tax certainty. Globally, all over the world, foreign investors and so domestic investors, it's not that people don't want to pay the tax, they want to pay the fair share of tax, but they want certainty, they want a path, which I think is happening. The key proposals that we have tried to cover here are capital gains, so that rationalization has already taken place, as Finance Minister did speak in our budget speech. We'll touch upon that. Some of the aspects of IFSC and government is promoting the International Financial Services Center, the KIF city at Gujarat. Some of the aspect changes which have come in as a part of that. The consolidation of TDS, TCS rates. I think this was a long-standing demand. There are various rates, and at times even we lose track of it, right? Whether it is 5% or 2% or a 10%. And so that rationalization certainly has taken place in number of cases. This itself leads to the ease from a deductor perspective for a TDS and TCS for the purpose of a collector's perspective, and hopefully it should help. Some of the measures certainly on widening and deepening of the tax base and anti-avoidance provisions which have been put in 94B, angel tax provision, we'll talk about it. And a number of measures on the tax administration and rationalization, which is very, very important. One is a policy, second is implementation. The implementation has always been a lacuna in the past, which is now getting eased out with a lot of those, the technology, the faceless, filing of returns online, but the administration part of it, certainly in direct tax part, and so on the GST front, there have been issues in the past, and how do we ease out and rationalize those is very important. Next, please. Coming to the first issue, which is the buyback of shares, which is an important part on 115 QA as it is today. Again, this provision has gone through a huge amount of change over the last 20 years, right when the buyback was first introduced under Companies Act 1956, Section 77A, which is now 68 of the Companies Act 2013, and whether buyback is taxable as capital gains versus dividend, and so on and so forth. Two kinds of buyback globally. One is where you cancel the share capital. Second is you can put it as a treasury stock, whereas the US, in the regulation like US puts in the treasury, India has followed the cancellation or a reduction of capital, which is what when the buyback happens under the Companies Act. And all said and done, the buyback change happened from taxation on the assessee to the company, like the DDT, the dividend distribution tax in 2013, and the tax was levied on the company. And again, it has now come back to the shareholder. At that point of time, there is I'm sure all of you would be aware, huge amount of litigation on Cognizant going on, because that buyback happened just after the budget was, fiscal budget was announced, but before it was actually implemented. To be specific, June 1, 2013. Here we also have a window of next 3 months to make sure how the change happens. Now here the tax moves from a company like the capital gains back to the shareholder, and it is treated as good as a dividend. To say that instead of distributing dividend, you are distributing. So this would become more tax inefficient from a shareholder perspective, of course, based on the rate that each shareholder is subject to tax, but taking the maximum rate of 35% compared to about 23% which you paid under the buyback tax. This change is effective from October 1, 2024. So we still have a window of next couple of months. If any buyback is impacted by any large company, it can apply to a listed company. It could be a closely held company. As buyback under Section 68 of the Companies Act 2013, then it will still be governed by the existing law to say the tax will be levied at the company level and no further tax on the shareholder. However, effective October 1, if the buyback is impacted, then it will move as a shareholder. Tax on a shareholder, there is a withholding tax of 10% TDS, which has been levied on the resident shareholder. And if you are a non-resident shareholder, it will be depending under Section 195 or the tax treaty, which may be applicable. Now, a couple of issues which come to my mind here is, what does this October 1 actually mean? Does it mean that the buyback announced before October 1 and implemented after that will be governed, or the actual payment will be governed? I don't think there is a clarity on that front, but I would generally believe that it is the time when the payment is received by the shareholder. So a buyback scheme is, of course, announced after October 1 and paid after October 1, then certainly the new regime will apply. But even if the scheme was announced before October 1, if the payment came after that, logically it should possibly apply. But yes, that point will need to be deliberated in terms of what is the taxable event, maybe a transitional issue more than anything else. So certainly you want to, for closely held company, you want to do a buyback today and implement before October 1, it will surely be governed by the existing scheme. In terms of the non-resident, another question which might come up as I was thinking around few discussions which have happened over last 24 hours is whether the definition under the Income Tax Act will apply or a respective treaty. Some of the treaties may have a different definition, a specific definition of dividend. If it links you back to the Income Tax Act, then fine, 222F will apply. But if there is not, this is the deemed dividend, right? So one would have to see that part. If there is a specific definition of the treaty, then I think it could lead to some confusion, and the treaty definition should override the provisions of the income tax definition under the Income Tax Act. But that's an issue which needs to be debated and answered. The other interesting part is that the entire amount of the sale consideration or the proceeds which have been given to the shareholder is totally taxed. It's a tax on the total receipt received, as good as instead of dividend, what government is saying, you receive this money instead of dividend as a buyback, we'll treat it as a dividend. And because of that, it can technically result into a capital loss. The memorandum does give an example that this capital loss will be allowed to be set off and carry forward. Of course, under the provisions of the Income Tax Act, against based on whether you are a short-term gain or a long-term gain, depending on the period which you are holding. And the capital loss will be then set off for 8 years, depending on whether it is a short-term loss versus a long-term loss as per the Income Tax Act. I think these are the issues on the buyback. Just try to give an example, assuming the buyback value is there is a little typo that we will put in: tax cost on buyback prior to July 23. This applies to the capital gains. Apology for that. It should be October 1. It's more an illustration. To say that the buyback value was of 5 crore and the issue price was 50 lakhs, under the current regime, the taxable amount is 4.5, and tax comes to on a 4.5 crore about 1 crore rupees, 23%. Now, just because it is moving from a company to a shareholder, and here illustration wise, we have taken a full rate of 35%. So on a 5 crore number, not on a 4.5, on a 5 crore, the tax comes to 1.75. Of course, on 50 lakhs, which will be carried forward, there will be a 20% tax saving in future, this year or in future. So that 10 lakhs you can reduce. But still, if you are on a, all the shareholders are on a more than 23% bracket, in that situation, the new law will be tax inefficient from a larger shareholder perspective. If it was, and this makes sense, right? Like the DDT has happened, that dividend distribution tax has gone back to the shareholder to say that the shareholder should pay the tax and not the company, because the higher category HNIs paying the highest rate are getting the same treatment as the lower category, or maybe somebody who is not subject to tax, with the tax, the limit is less than 2.5 or 3 lakhs. So whereas the 23% was taxing everybody equally, the new change will tax people based on pay as you earn basis, like a normal income. So I just thought we'll give a little in this thing that if the rate is more than 23%, then the tax will increase, and it will be today. The loss may be set off this year, it may be set off over next 8 years, it may or may not be set off. So the exchequer will certainly make more tax revenues, I would think, based on the new law. A lot of issues spoken on the rationalization of capital gains, and at a time this change happened over last almost 40 years. So many changes on capital gains, tinkering here and there every year. Whether it is a long term is 12 months versus 24 months versus 36 months, whether for a particular category the tax is 10% or 20%, if you are a resident versus non-resident, so many complications at times we lose track of it, right? So what government has tried to do is to totally rationalize, and I think it is a very welcome move. Here maybe somebody may gain, somebody may lose, but overall I think it's a very simple rationalization which has happened. Essentially, you are saying there are two rates. One is a long-term rate in case of a listed security, which is today 10%, has now become 12.5%. And short-term has become a 20%. So there are two rates, 12.5 and 20 is one to be seen. And this includes almost all assets, right? Including even immovable property, and that's where there is some confusion which has arisen yesterday, since I think finance minister was trying to explain whether indexation will apply, not apply. We'll just talk about it. So 12.5% and 20%. The non-resident currently are paying tax at 10% when it is a long-term gain, be it shares or any other security, property, anything. Now, they will again pay 12.5%. So the difference between resident and non-resident is gone, which is one good part. And then 12.5% for all listed securities. Also, the unlisted securities and other non-financial assets like real estate, gold, everything. Where the only difference is the rate is 12.5%, but the period is 12 months for a listed securities, which it is today even now included units and business trust. And for other assets, like shares of the unlisted company, wherever there is a transaction happens with a private equity transaction, where the closely held shares get transferred, the rate, the period is 24 months, which is also even today. So that rate is now, long term would be the 12.5% rate. So that is a significant benefit which has happened for from 20% to 12.5%. Now, of course, as a part of this rationalization, what the finance bill is saying is that there will be no indexation possible. That you already given that benefit of indexation from 20 to 12.5%. And for short term, in case of STT paid shares, securities, it has gone from 15 to 20. Of course, it is more than a year. So if you are saying less than 1 year, you are selling the shares, then 15% has become 20%. And for other short-term assets, it is still the usual rates which will apply. Now, that may not be much relevant in actual practice. So, three things relevant: the listed securities 12 months, the unlisted and the other assets, non-financial assets, 24 months, rate is 12.5%. And for the listed short-term gains, it is 20%. No indexation available. A small exemption limit of for listed shares, a 1 lakh exemption has been increased to 1.25 lakhs. Now, one question which came up, it more out of clarification, was that if I was holding a property before, say, 1990, okay, so I can always replace the fair market value as on 1/4/2001. Whether indexation will be available, the way bill reads is clearly no. However, based on the finance minister's speech, some people have interpreted it otherwise to say that if you are holding a immobile property for a long term, say from 1990, then you could replace the fair market value as the cost of acquisition as on 1/4/2001 and then index it to today, which will be some 3.5 times. What she meant was, I think, that only the fair market value will be replaced, which is the law today, and it continues even going forward. But indexation is not available as we interpret and we have analyzed it. So there would be a loss, and we will explain that a little bit in the example, that even for an immovable property or a gold, if you are long term, the rate will be 12.5%, but without indexation. Be it the property held today or property held decades back. Because the number of people we have seen in our actual practice, you inherit the property. A lot of non-resident or resident inherit the property and then you sell it, right? Then you get the cost of acquisition, holding period of the prior owner, and then index it. So that brings quite effective. So from a immobile property and the shares perspective, we don't know. Even for the shares, the closely held company, if you started a company 30 years back, today the valuation may be significant. But the only thing you can do is replace it by a fair market value as on April 1, 2001. And now the indexation under the new law is not possible. And this law is effective today, on or after July 23, 2024. There is no grandfathering, where I think some people try to interpret that any property held before July 23 is grandfathered. I don't think so. That's not how the law reads it. Can you just move to that next slide where we try to explain the example to say that if these are all hypothetical numbers, that if the property was sold today and it was held much, example number 1 on the left hand side, what we have tried to give is that a property was held, say, in 1990, and the cost of acquisition, which is a fair market value, was, say, 6 crores here. Then under the current or old regime, now it is old regime because the regime has gone already from yesterday, the indexation would have been possible if the property was sold before July 23 at 3.63 times, and the tax liability would have been 84 lakhs. Whereas after this no indexation, you simply reduce the rate by 7.5%. So as the property or asset is old, you may lose out on the indexation because of the indexation benefit. It depends. Particularly for property, it may happen because the prices have shoot up significantly. For closely held shares, it may actually not matter because we've seen number of PE transactions which have happened. Somebody started a company very small, right? And a service company, and then it just grew. So there was no capital being put in. Unless in a hardcore economy, you would put in further capital and then indexation was possible. But the cost of acquisition and index cost of acquisition has not been significant in the past. So those will certainly lose out, surely the property. Here, again, assuming the property was held in 2015, so the price may be as recent as to the market value. In fact, the price might have, since 2013, the real estate market has been actually falling, right? So the price may not have gone significantly. Here, the benefit would certainly be in terms of 7.5% delta that you are getting. So the trade-off would be And now there is no planning possible because the event has already happened. If you sell the property today, you are governed in the new regime period. So 12.5% without indexation. That's how we would look at it. Unless some further clarification come in. But as it stands today, no indexation. Next, please. This one issue, I think, and I would say for the closely held company which now goes IPO since 2018, 31st January 2018 was the date, as all of you may know. The question is that you sold it as a closely held company, but you are getting the benefit of a listed entity. The tax rate is 10% instead of 20%. And the question which came up in few cases is this is like the extra smart planning that people try to do, to say the way it works is you're just selling it after the listing has been announced, but actually the stock has been listed at some 15-day window where there is no market price available. So some of those taxpayers, the SSC had taken a call that, oh, although I know the share, my sale consideration, the cost of acquisition is not known because the wording fair market value was not defined. And so still the good old BC Srinivas Sethi of 128 ITR 294 used to come during my exam days. Even people try to impress, even try to implement even today. So say the competition provision fails, doesn't work in today's day. And now the change has been happened, defined what is the cost of acquisition based on the cost inflation index, and you would determine the cost of acquisition. So these are just to take away that artificial planning that people did it in some cases. And this change may look like it's restored because the amendment will apply from assessment year 2018-19 when the change actually came on 31st January 2018. So it may look retroactive, but it's more clarificatory, I would believe, and it's not a retrospective change in that sense. So surely for those cases where in the past people have taken a call that the cost of acquisition was not determinable and the competition provision fails, will all be subject to now tax and tax plus interest and penalty as the case may be. Can we just move to show how it actually works? Hetav? So just take a simple example. Let's assume the sale consideration is 1,50,000 here. And the fair market value prior to finance bill, if you take a call, FME is not known, so it is not applicable. Although my cost of acquisition, I knew my cost of acquisition. That's the beauty. But we said, no, I don't know the index cost of acquisition because we don't know what is the fair market value as on 31st March. Since I'm unlisted entity, you do not know that. Now, they have just given a cost inflation index of 2017-18 versus the time when the property was actually bought. So in this example, 10,000 into 272 was the index at that point of time. Divide by 240, which was the index when I bought the property in 2014-15. So my index cost will be 11,333. Just because I could not determine that extra 1333, those who took a call that it was not taxable will suffer because of that. So it's more a clarificatory, I would believe, than anything. And this always is a window of about 15 days. It may be very relevant because this may apply to a lot of private equity who have put in the closely held company or promoters who are selling the shares as a part of the IPO process. Next, please. Some of the tax incentives the government is supporting, as I mentioned, IFSC full-fledged, trying to make it as an international financial center. We've seen number of, in last few years, number of banking, insurance, reinsurance companies, funds management companies have set up shop. The entire center is set up more to attract foreign investment into the country. So why do we need London or a New York or a Singapore or a Hong Kong, and why not GIFT City? And we've seen number of people putting in, having said that, we have a 10-year tax holiday for units set up in IFSC. There are some tinkering which has happened this time. to say that the unit will also include, the eligibility will also include now the retail fund and exchange traded funds in the GIFT City. One important change which has come up is in terms of Section 94B, which is Section 4 of the BAPS regime, in terms of interest paid to a related party, which is applicable to a normal unit. And this is a global unit mandatory standard. India has implemented a 94B to say that if any interest is paid to an associated enterprise, then in excess of 30% of the profit, it will be disallowed. So the deduction for interest is applicable only up to 30%. Number of countries in the world have implemented, so is India under 94B. Now, if you are a banking or an insurance company, then even under the mainland India, there is no disallowance. 94B is not applicable. So is the case in IFSC. They have now added that if you are a finance company, if you are not a normal NBFC, but you are a pure finance company, which may not be regulated, even those finance companies will be eligible to this relaxation. Only if you are in GIFT City or in IFSC. So any unit of finance company set up in IFSC, if interest is paid to a group entity, to an associated enterprise, 94B will not apply. I mean, in practice in IFSC, since there is a 10-year tax holiday, during the tax holiday period, actually, it should not matter much. Because anyway, the income is exempt for 10 years on a tax holiday. But here, beyond tax holiday, you could take 10 out of 15 years in the year or post-tax holiday. Even a lot of people in the initial stage do not take the tax exemption. They're saying, I'll take it like the ATIA from a fourth year or a fifth year onwards. Initially, there may be loss. So to that extent, I think this would be important change for finance companies. Essentially, the government really wants to promote the finance companies. There was one angle which we had put in, go back on the slide. We tried to represent there is one issue in case of insurance and reinsurance companies. Technically, number of those companies operate through a branch structure and not through a company. And if you are a branch, then MAT is technically applicable. Now, if you look at the Section 115 JB, MAT was reduced to 9% if you are a unit in IFSC, vis-a-vis you are in mainland India. Now there is an option that if you are an Indian company, you can choose not to pay MAT and go on a normal regime, right? But when it comes to IFSC, particularly for reinsurance companies, for foreign banks, you always operate through a branch structure because of business reasons, right? And in that situation, MAT is technically applicable. We had represented to the IFSC authority through that, sent a memorandum, but we don't find that. And one option is that MAT doesn't apply to a branch of foreign company. That there are decisions which are favorable, but still it's a litigative issue. So that's one issue which is unresolved to an extent. There was an issue on the GST in the mainland India, and rather have Parag speak about it. That part has been addressed for the insurance and co-insurance right now. So that issue may not be there. And the third issue is more relevant to a pillar 2 in my view, although we don't find pillar 2 here to an extent. When we talk of the equalization, we will touch upon it. But you may have a tax holiday here. You may pay 0% or you pay a MAT of 9%. Technically, there is still that exposure of pillar 2 in the ultimate parent company where you are coming from. So that's more an issue for the foreign jurisdiction, the home country, than anything else. But this one thing which has been spoken when we speak of pillar 2, to say that the benefit which
Yeah, I can see that he's having some internet connectivity issues. So in any case, he had wrapped it up to the extent of tax incentives to IFSC. We can move on with the next slides, and then we can request Uday to add further.
Sorry, I just got disconnected.
Sure, sure. I was just
I'll just cover this shortly.
Sure, sure, done.
There was a signal to me to stop, it looks like, but I'll cover in 30 seconds. What I was on that, whereas a pillar 1, when is implemented, is mandatory. Amount A is mandatory, the attribution of profits. Both amount B of pillar 1 and the entire pillar 2, the global minimum tax, the globe rules as they call it, is optional. So the country may choose not to implement pillar 2. Okay. But if country chooses to implement pillar 2 and is part of the inclusive framework, which India is among 140 countries, then the pillar 2 has to be implemented as per the rules set out by the inclusive framework. So then you don't have your own rules. And so in that situation, if you are a unit in IFSC, there may be a pillar 2 issue, and there are planning opportunities, I'm sure, around that. But I just thought I'll park that point here. Not relevant to talk today, but the benefit which is given by the tax holiday may be taken away by pillar 2, purely from a tax perspective. And they have not said any unit will be covered into that, any tax holiday, which will also include the unit in IFSC. Yeah, next, please. And I think I'll just stop here. Maybe Krishna, you two take on few slides, and I'll come in wherever.
Sure. Yep. Thanks, Uday, for that conversation. I think pretty much the audience would have enjoyed the entire brief discussion on most of the transactions. And now from here onwards, we get on to the mundane stuff of compliance and routine procedural aspects. So for
very
yeah, I'm pretty sure it is very important. And in fact, while transactions are specific to companies which are more rarer, you are going to have tax litigation, tax compliances on a day-to-day basis. So in that sense, it is going to be imperative for everyone who has litigation across the board. And obviously, compliances are part of the bread and butter for every entity in India. And again, this is a bit of a legacy item because taxpayers, especially having litigation in the past, would have been aware about the Vivad Se Vishwas scheme. And then it was a huge success in the past. In fact, similar schemes were there even under the indirect tax regime as well. And considering the litigation which has now gone in the last 4 years, since when the previous Vivad Se Vishwas scheme was introduced, the scheme has now again been introduced and very similar provisions compared to the last time. If you see briefly, they've proposed two broad bifurcations. What happens if amounts are remitted before December 31st, 2024, and what happens in the event of amounts remitted post December 31st, 2024. And again, the amounts are split into quantum appeals and non-quantum appeals. So therefore, wherever there are tax arrears and aggregate of disputed tax, interest and penalty, there is a bifurcation about appeal proceedings up to January 31st, 2020 and appeal proceedings post January 31st, 2020. And then again, 110% of disputed tax prior to December 31st, and then 100% if the appeal pertains to post January 31st. And then likewise, in the context of post December 31st, if the amounts are being remitted. Obviously, if you can see the difference being, if you are making the remittance before December 31st, the tax paid or the tax plus penalty plus interest paid is slightly lesser because it helps the revenue authorities as well aggregate amounts and mobilize funds before December 31st itself. And post December 31st, if you remit, you're going to pay slightly higher amount. And the same is the case even on non-quantum appeals as well. And the threshold which is indicated over here in the case of department or revenue appeals, the quantum will be considered at 50%. Black Money Act, there's a brief reference to what happens in the instance of money recovered from Black Money Act and how we go about in terms of utilization of those funds. So there's a proposal to grant immunity from imposition of penalty on account of failure to disclose foreign assets in the income tax return of the SSE if the aggregate value of the foreign asset does not exceed 20 lakhs. So here the entire discussion was what happens if, say, there is a minor amount of, say, 5 lakh or 10 lakhs and the penalty imposed is much higher than the actual concealment. So from a perspective of rationalization of provisions, they've said, okay, if the amount does not exceed 20 lakhs, we're not going to consider it for the purposes of penalty, and therefore that will be considered as a smaller amount. And then in terms of the recovery of black money itself, like I was saying, if there is amount being recovered, and then under the earlier provisions, even if a black money was recovered, how do you mobilize that amount towards taxes? That was the challenge. And therefore, to address it, they've inserted a section 132B to explicitly allow recovery of liabilities under the black money. And therefore, if there's any tax outstanding from that black money, taxes will be recovered appropriately under section 132B. Moving on to the personal taxation regime, I think this is again something which most of us will be impacted by one way or the other. Lots of cheers for the lower middle class, and especially for people having income up to the slabs of 15 lakhs, and obviously above 15 lakhs as well. There's a gradual movement from the older regime to the newer regime, and I think ultimately the new regime will be the one which is going to stay, and the old regime will get phased out eventually. And I think that is how they've been providing more and more incentives for people to move into the newer regime. And even in the prior years, for people, especially in the business income category, once the option was made to move to the newer categories, you were supposed to stick to those provisions. So by and large, if you look at the taxpayers who are sticking to the existing slabs, will be typically the salaried payers who are availing of HRA benefits and standard deductions and ATC incentives. So if you look at what is the proposal in the current finance bill itself, two key items stand out. One is there's a standard deduction which is increased from 50,000 to 75,000 for salaried earners. And this is only if they are opting for the new regime. So like I said, the revenue authorities or the government is constantly making an effort to push taxpayers towards the newer regime. And likewise, increase in family pension deduction as well, from 15,000 to 25,000. The other incentive which has been provided is towards employers' contribution towards the national pension scheme. And again, this is more of a rationalization because the existing provisions already capture 14% deduction where the employer is a government employer. And in case of non-government employers, the existing threshold was 10%, which has now been rationalized and made equal to the government employers. And to that extent, 14% has now been made as the standard deduction. There have been some tax avoidance or tax leakage provisions which have been tried to be rationalized. So the government's view is that in certain cases, people who own residential properties and either letting out the residential properties or partly letting out the residential properties, they were trying to claim a higher deduction because obviously the section 24 provides for a 30% deduction on income from house property. But under business provisions, technically someone could have said the amount of deduction being claimed is more than 30%. So the revenue authorities are trying to curtail that and saying that if it is a residential property, it will be continued to be categorized as an income from house property, and you can't move this under the profits and gains of business of or profession. And likewise, on the deductibility of certain expenses. So if there are certain positions being taken or certain legal infractions being committed, what happens in relation to settlement of those cases? So say, for instance, you committed a crime, which technically speaking, just taking for example or illustration sake, and then you say, okay, in order to avoid conviction, you say, I'm going to settle by making a remittance of certain amount. Will that amount be considered as a business expediency, considering that you have made that remittance for the purpose of your business, which is what is being tried to be curtailed over here. And they are saying that if certain amount is used as towards settling proceedings, then that becomes a non-deductible business expense. The other item is towards the allowability of remuneration towards partners. And again, if you see the existing deductibility limits were pretty old. In fact, on the first 3 lakhs of the book profit, 1.5 lakh or 90%, whichever is more, was the limit. And I'm pretty sure if you compare this with the overall slabs which have been raised in the past several years, this limit has continued to exist as it is. So that limit has now been increased to 6 lakhs. And out of the 6 lakhs, the partnership firm will be able to claim a deduction to the extent of 3 lakhs or 90% of the book profit, whichever is more. And on the balance of profit, that continues to be taxable or the deduction will continue to be applicable to the extent of 60% of the book profits. Here, I think again, these are some interesting amendments which also have a bearing on the OECD Pillar 2 perspective as well. And I would, it will be great if Uday can again rejoin on this slide.
Sure, Krishna. So as we know, on the pillar one, since it is mandatory, as I mentioned, whenever that comes in more for the digital economies, companies like Amazon, Google, Facebook, who have operations in India, but they don't have any physical presence. So they are not taxed today. We do have significant economic presence provisions under Section 9(1) of the Income Tax Act. But under the treaty, since there is no P, which is a concept more in the physical presence test, there is no P of this company. The servers also are outside India, and so they are not taxable. And as a part of the Pillar 1 discussion, which was going on since 2017-18, India introduced equalization levy to say, to the extent that Pillar 1 rules or the draft P rules are not notified, Pillar 1 is not implemented, there will be an equalization levy. It started more as a levy on the advertising, online advertising. And then in 2020, which is the crux, the 2% levy was introduced on e-commerce operators, and which is what they're paying now. Interestingly, very smartly, the Indian legislature introduced equalization levy under a separate act, as all of you would know it. It's neither under the Income Tax Act nor under the Indirect Tax like GST. It's a separate levy. And so the 2% levy, again, the levy is on a non-resident. So 2% of the amount which is being paid, because say most of the companies, maybe all these Fortune 500 who are relevant, are say based in USA today, there is no tax credit, foreign tax credit even be possible. So 2% is a cost. Now, there was a huge amount of debate, discussion. US tried to implement under US restricted tax practices of 301 of the US TRC to say that we will retaliate. Then there was a discussion which happened. And finally, a statement was issued about a couple of years back in 2021, I think, end of 2021, when the statement was issued on Pillar 1 to say that India will continue to levy equalization levy when the Pillar 1 is implemented. As a part of that, mandatorily all the unilateral levies have to be abolished. So India is not the only country. France has introduced, the UK has introduced, so many other European countries have introduced, and they all agreed with USA under the treaty to say that equalization levy will be abolished. Now, this year we see that still Pillar 1 is in that sense in a draft stage, not implemented. But when we see the memorandum and again the finance minister's speech yesterday to say that we are voluntarily giving up equalization levy in the hope that Pillar 1 will be implement very soon, and in a larger kind of a trade interest. Also, it is agreed that any equalization levy which is levied in the interim after the statement was issued in October 2021 until Pillar 1 comes into place, that will be paid in interim and will be given as a credit post Pillar 1 comes into the picture. So today it's like a MAT. Anyway, you're paying it. So India has voluntarily given up equalization levy, and this will reduce a lot of litigation. But to the extent of Pillar 1 coming in, to an extent, I think is a way towards moving to Pillar 1 and and I would say even Pillar 2 to an extent, because there's a global minimum tax, the transfer pricing part, which is linked to this entire situation. And finance minister did say that we want to move towards Pillar 1 and Pillar 2, will implement it, and that's why as a step towards that, equalization levy has been abolished going forward. Coming to the angel tax, which is, I think, again, been a huge amount of debate for last 10 years, surely, if not more. 56 to 7B was introduced, and actually it is a levy on capital. You are taxing a capital account transaction. And the whole objective of introducing came because of the Shell decision at that point of time, where a wholly owned subsidiary introduced capital at a significant premium. And at that point of time, there was a thought process that your own money was, black money was coming in the form of a capital and so on and so forth. That was 56 to 7B was introduced in 2012. I think it's almost more than 10 years. It was introduced only for resident, and that created a lot of those, mainly startup industry is where the 56 to 7B says that if private company issues any shares to a resident, now it applies, of course, since last year also to a non-resident, to all taxpayers, that if it issues shares at a more than the fair value, then that excess premium which is received will be treated as a deemed income. Actually, you are taxing a capital account transaction. So that, I mean, India is possibly only country, one of the very few countries in the world which taxes such. And there was a reason behind doing it. It has created all kinds of litigation, particularly for startup industry. The funding was becoming an issue, right? A small kind of an e-commerce kind of a tech company with some good idea may not have any even revenues today, but it brings a huge amount of premium because the valuation is significant in the hope of a future unicorn. And those companies were subject to, then there was an exemption given to approved startups, some venture capital fund. Last year, it was introduced also for a non-resident, which is the worst part, right? And there were all kinds of rules being introduced, countries being specified, and valuation rules. And now you find that, look, there is a sunset clause. So there is always a back and forth, but ultimately a good end to a wrong provision, I would believe that, because it was really hurting mainly the startup industry. So, and this change is effective from current financial year, assessment year 25-26, financial year 24-25, effective April 1, 2024. What happens to the past? Question will remain. That litigation will continue. Hopefully, for genuine cases, the department should not pursue those cases, right? In genuine cases, only when you have an information that, yes, your own money has come in some form, or then you take that call. But just because the money came at a premium, this provision created 56 to 7B, created a lot of issues, litigation, which should really help up more the startup industry now going forward. So it is settled in that sense, right? And of course, the other flip side is 56 to 10. This applies to the primary issue. The secondary issue or a transfer of shares get governed by 56 to 10. Those provisions are still intact. And there, of course, the valuation is book value. The fair market value is Rule 11 UA, so which is much easier and simpler. Here under 56 to 7B, the valuation was as per the fair market value and mainly the DCF method. And the money which came was even significantly higher than that, which was the difference was getting taxed, which is, and this was impacting the funding for particularly for the startup industry. A lot of startups actually moved their residence because of this, just because of this provision. In addition to, of course, business need from India to overseas, say in Singapore or in US, any outside India, because the foreign investor who came, they said, look, I want to invest in your Indian venture, but not in the Indian entity. So give me, there were a lot of flip structures which happened to reverse this 56 to 7B by forming an entity outside India. Of course, there were issues on round tripping and everything from an RBI perspective, which are now gone. But this should bring back those startups back to India. And we are seeing for some large companies today a reverse flip happening already, right? For business reasons, not for tax reasons. So even those entities would really benefit from a funding perspective. Yeah. Over to you, Krishna.
Yeah, I think in the previous slide, there were like a couple of minor points regarding increase in STT rates, considering the reasons given seems to be a bit weird, saying that there's huge traction in F&O options and therefore we are increasing the rates. And then just to add another point on the equalization levy and the OECD pillar bit as well, I think a lot of expectation was there that there is going to be some form of amendment introduced under the current budget itself. Especially considering countries like Singapore as well have already announced implementation from 2025. And therefore, even from a preparation perspective, one would have expected that if something was announced, even say in the middle of the year like now, the preparation would have been much better for April 25. Whereas now I think the anticipation moves towards the February budget, and especially post the US elections as to how they are going to bring it out and implement it. We can move to the next slide, Hetav. Yeah, one other one other amendment which is more transaction specific, which although it doesn't appear on the face of it, is 47(3), which is an exempt transfer. There, the definition or the provision, exempt transfer provision has been amended to now only cover individuals and HUFs. So if we go a decade or so back, there were several AR rulings, which effectively were saying company gifting the shares of another group company, and the new holder of the shares becomes a Mauritius or a Singapore company. And a lot of companies were saying, because 47(3) covers gift by any person, even companies getting covered under that. And in fact, interestingly, even the memorandum under the current budget explicitly says that 47(3) is intended for individuals with love and affection, which is a primary criteria for gift. And therefore, they are clearly making it very evident that this is not what is intended for companies. So therefore, 47(3) now is limited only to individuals and HUFs, and no possible tax avoidance by companies. Reduction of tax disputes, the thresholds for filing appeals has been raised, as you can see, across appellate authorities, whether it is Income Tax Appellate Tribunal or High Court or Supreme Court. From the existing limits of 50 lakhs, 1 crore and 5 crore, it has now been pushed to 60 lakhs, 2 crores and 5 crores. This slide deals with transfer pricing, and I would request if Hetav can explain or brief us on this particular slide.
Thank you. Thank you so much, Krishna. Hi, everyone. So I think transfer pricing, there are not much changes, but since I think we are already 1 hour and we have 30 minutes left and we have much to cover interestingly after this. So just to quickly grab 5 minutes of everyone and to just update and also giving the flavor of the global, including India. So how is India different from global, and what are the other countries doing it? And so coming with the first amendment. So the very first amendment relates to the rights, the authorities of the transfer pricing officer to include the determination of the arm's length price to the specified domestic transactions. So like everyone here would be aware that the specified domestic transactions was a part of the statute for 3-4 years, but then ultimately it got scrapped because it was a compliance burden to the taxpayers. But still, I think there are very important provisions in the SDT, in case of the manufacturing unit, where they avail 15% of the beneficial tax rates. So there were instances where the transfer pricing officer were aware of the cases where there were not reporting which were done in Form 3 CAV, which were to their knowledge. But I think the transfer pricing officer's hands were really tied in terms of the law of not getting it opened for the scrutiny, because it was not referred to him by the assessing officer. So here the amendment is very clear that if anything comes to his knowledge during the scrutiny of the transfer pricing, he can very well open it and ask the questions and also levy the penalty as to why it is not reported and why it is not benchmarked correctly. So I think his the wings are widened in terms of even determining the arm's length price for the specified domestic transactions. A second amendment is in relation to what Uday Ved sir really covered in a very nicer and a lucid way in terms of thin capitalization rules, which is now equally applicable to the financial services companies which are set up in the IFSC. So essentially, it's something which brings them at par with the the banking and the financial industries companies. The reason being, this financial services companies have a huge amount of capital investment and the loans what they're taking it from their rated parties, and they have a huge outflow of the interest payment, and it's more of their day-to-day routine expenses. What is the interest what they claim it. So it's good that it is given some kind of a leeway. So there was already some kind of a hue and cry which was there in terms of these industries or the financial institutions within IFSC as to why there is no clarity. But now with this kind of amendment, the companies which were doors to open up their shops at IFSC have actually thought of doing it in a real time and going ahead with setting up their branches and also the companies within the IFSC unit. So this is very welcome move in terms of the clarification and also giving them the boost. The last yeah.
Just one added point here. This is relevant in IFSC because in addition to banking and the insurance companies, there is also a specific fintech law in IFSC today. So the authorities are promoting fintech companies. So either a tech company doing a financial services or a financial services rendering, companies in the tech business, both inbound and outbound. And so when you want to promote that fintech law, this was becoming an impediment to an extent. This is an issue even in the mainland India. But this exemption today has come only for the fintech companies. If you are a unit located in IFS, it will make things easier. Of course, during the tax holiday period, again, as I mentioned, this may not be relevant much. But if you're not on that, then this will ease out that issue. I'm just saying. Just as a
Absolutely.
more a business angle, why this tax change has come in.
Absolutely. Totally agree with you. So lastly, in case of transfer pricing, the honorable financial the finance minister spoke really well on the transfer pricing, saying like, that there's some kind of a tax certainty is what is expected, and there is a requirement to reduce the litigation, especially in the international tax division, by expanding the scope of safe harbors. So safe harbor is something which is there already a part of the law since many a time, but it's a failed mechanism as such, because none of the taxpayers would like to go for the safe harbors, because there is a compromised formula in terms of the rates which are quite high, and it's not attractive for them to avail. And also there is a restricted scope of services only where the safe harbors are really applicable. But over here, she has hinted really well that the safe harbor would be kind of put into place very soon. Though there is no any kind of the amendment what we could see in the memorandum on the finance bill. But if you were to given a guess as to what could be the transactions which should be included under the gamut of safe harbor, and the very first thought which comes to the mind is that the amount B of pillar one, which relates to the base marketing and distribution, because the very first draft publication which came by the OECD, it clearly mentioned that as an option to implementation of amount B, the local jurisdiction can very well place this as a part of their safe harbor rules. Though it didn't came as a final paper in OECD pillar one amount B, but in one of the consultation paper, it did give a hint that the company, the countries may follow it as a part of safe harbor rules. So I think over here, it's very good to even give the international flavors of the jurisdictions like USA. So USA recently, just couple of months back, have started like a campaigning by the IRS, which is the US tax authorities, by issuing the notices to selected group of companies into purely a distribution activity, which has a very low margin, to just check whether they are adhering to the transfer pricing rules in terms of keeping the documentation and keeping the arm's length margin or not. So over here, the OECD Pillar 1 amount B is very clear that the maximum number of litigation which is ongoing in the transfer pricing arena is the distribution activity, because be it a manufacturing industry, trading industry, wherever the linkages of production are there. Of course, for the tangible transactions, the amount B gets triggered, and it's good to hope that sooner or later this will fall a part of the safe harbor rules. And of course the the last thing that these amendments are really expected, because over the years the transactions are same for the safe harbors. The percentage has gone below, to few percentages what were there earlier, but not up to the mark, because if you say the safe harbor rules are saying at the range of 10, 20, 20, 22%, when the arm's length range actually as per the benchmarking hovers around say 16, 17%. So over here, the rationalization is required in a way of bringing down the margin, plus adding the services and the some of the transactions under the gamut of safe harbor rules. Yeah, I think that's it from the transfer pricing
Just
side.
want to
Yeah.
put in one point here. If you look at Hetav amount B pillar 1, it is not mandatory, it is optional, as I understand. And India has given a clear reservation in the report in pillar 1 amount B, mainly because the way entire margins are being calculated, it is based on the cost formula. There is a mechanism, cost formula. If we implement, then you will have to implement it the way the rules are being framed, right? And because of the locational advantage in India, the cost is generally low compared to a developed country. We were talking to some people within finance ministry, this issue did come up. And that's why we may not implement amount B pillar 1. That's how I look at it. And we may go through a safe harbor rule. Because just based on the cost, if the margins are determined, say a normal margin for a distribution activity here would be say 6 to 8%. Would that be fair to assume that? Where maximum you could charge is between 1.75 to something like 5%. And you won't even come to a 5.25, the third category. You may be somewhere in between 175 to 3% range, whereas here it is 6 to 8%. If we implement based on the cost, and so a very interesting point that somebody made to me within finance ministry, a very senior officer, saying that this is taking away the locational advantage that India has. And of course, we are not a back office mundane. These are high-end, people are setting up the global center now, engineering center. But still the cost is an issue. That's the advantage, which is being taken away in the form of a low margin. So maybe India may or may not implement Pillar 1 Amount B, we don't know, and it will go through a safe harbor rule. Maybe I'm seeing that as an indication here. God knows how this will come through when it gets implemented. But I just thought this is another perspective which is important to keep in mind.
Absolutely, correct. I think back to the panel for the rest of the slides.
And I think if we are, Arun, are we okay on the time? Because we have a lot to cover in GST, honestly. So if the time is an issue, then we can first cover the GST part and then come back depending on, because these are, I think, a lot of things which should have been discussed over last, the rationalization, everything, Krishna. Just a question to Arun.
We can
maybe
do that.
we can do GST part, which is important first, that change, and then depending on the time, we can come back to this.
We can, which is fine.
So, Chanchal, you can touch upon the little custom part and then let Parag Bhai take over the GST first.
Sure, sir. Sure, sir. Yeah, so thank you, Uday sir. Thank you, Krishna sir. Thank you, Hetav. So as you all are aware, yesterday, Finance Minister Nirmala Sitharaman presented a historic 7th consecutive union budget. So from a custom perspective, if I see, this budget was an eventful, as the custom duty rates on the certain items have been carefully categorized in line with the needs of the economy. So the finance minister in her speech also committed and proposed to take a comprehensive review of the custom duty rates over the next 6 months. So there has been a change in the custom duty has been proposed, where the decrease in the custom duty have been announced for some agriculture products, then coming to the aqua farming and the marine export, some critical minerals, some products related to the steel sector, then the copper, textile, leather sector, and some like custom duty have been reduced for the cancer drug, especially. The same has been mentioned in the budget speech as well. Similar to the medical equipments and the mobile phones. And the most important over here is that custom duty have been reduced for the gold bars and the silver bars. So if historically we see, like, India has always been conservative about reducing the duties on the gold and other precious metals. So this time, like, the custom duty have been reduced for this gold bars and the precious metals. So this is a welcome move. And similarly, there have been announced the increase in the custom duty related to specified telecom equipments, then the plastic, chemical, and the consumer goods, and some roasted nuts and the seeds, etc. So this initiative aims to stimulate the growth of the domestic manufacturing in sectors playing the major role in the India's export economy. Similar to some trade facilitation measures are proposed, such as increasing the time period of duty-free re-import of the goods exported under the warranty. So the increase in the time period of the duty-free re-import of the goods exported out from India under the warranty has been increased from 3 years to the 5 years. So which is a very welcoming move, and this is further extendable to 2 years. So already the time limit has been increased from 3 years to 5 years, and this can be further extended to the 2 years. Similarly, articles of the foreign origin can be imported into India for repair subject to their re-exportation within 6 months has been extended now to a 1 year. That also is further extendable by a 1 year. And then one amendment has been proposed in section 28 DA to enable the acceptance of the different type of the proof of origin provided in the trade agreements. So this proposal for enabling the acceptance of different proofs of origin for duty benefits under the trade agreements would help for the on-ground procedural challenges. So now coming to the this next amendment, where I would like to give the some brief about this amendment. So one scheme which is called the manufacturing and the other operations in the warehouse regulation, which has been introduced in June 2019 to provide the significant benefits to the importers by allowing them to defer the custom duty payments until the removal of the goods. But later the instruction has been issued by the government, where they have specifically excluded the solar power generating units from obtaining the license under this manufacturing and other operation in warehouse regulation schemes. But later, in one judgment, Delhi High Court had quashed the instruction issued by the government, which excluded the solar power generating unit from obtaining the license under the manufacturing and other operation in warehousing scheme for warehousing purpose. So now the proposal has been made to empower the government to exclude a class of the goods from the benefits under this scheme. So there has been one proviso has been inserted in subsection 1 of section 65 of the Customs Act, granting the central government authority to specify particular manufacturing and other activities concerning a category of the goods that are not allowed within a warehouse. So now this particular amendment has been introduced to quash this Delhi High Court judgment. So now the central government can specifically categorize, notify the category of the goods where this manufacturing and other operation in warehouse scheme won't be allowed. So now coming to the excise duty amendments, there are not much amendments pertaining to the excise duty. There are the two amendments. So one is the extension of the time period for submission of the final mega project certificate has been increased from 120 months to 156 months. So that extension has been given. Similarly, another amendment has been introduced where the clean environment cess, which was levied and collected as a duty of the excise, is being exempted now for the stocks lying as on 30th of the June 2017, subject to the payment of the GST compensation cess on supply of the such goods have been made. So if the uh, uh, GST compensation cess has been paid, then clean environment cess need not to be paid. So that's all related to the customs and the excise duty amendments. Further, like the proposed amendments of the GST law in budget primarily aim to implement the recommendation made by the GST Council meeting in the 53rd Council meeting, which we have elaborated in our next slides. So which will be taken by the Parag Bhai. So over to you, Parag Bhai. Now you can take the GST slides.
Thanks, Chanchal. Friends, as GST budget, the amendments in GST budget mainly find its roots today from the 53rd GST Council meeting, which was held on 22nd June 24, the first one after the newly elected government. After the first 53rd Council meeting, there were nearly 20 circulars, 4 notifications. Notice circulars were for corporate guarantee, annuity, GA place of supply for custodial charges, warranty, life insurance valuation, etc. And now, and plus there were notifications which prescribe some of the rules. So many of the recommendations of the council meeting were by way of either notification, circulars, etc., where clarifications were given. And besides that, there are further amendments in law also to give effect to this council meeting and to ease the procedural matters. So now if one looks at it, the taxation of ENA has been a disputed point from the inception of GST. Whether ENA used in the manufacture of alcoholic liquor is liable to GST or whether it's a state levy. Various froze judgments, local judgments, high court judgments, wherein writ petitions, and now finally this point has been cleared that the ENA or rectified spirit used in manufacture of alcoholic liquor is out of the purview of GST. So no GST will be applicable. Second amendment is the government has taken a power to issue clarifications wherein a tax has not been levied, short levied, or this is due to a general prevalent practice, trade practice, the government can regularize the matters on as and where basis. So now if one looks at, there have been many instances wherein, the government has given a circular, a notification that the past issues are settled wherein there were rate disputes of whether a 12% or 18%. The government has issued a clarification that as of date, it will be clarified on as and where basis. Those who have paid 12%, it's fine. Those who have paid 18%, it's fine. Only thing is no refund will be granted and all the matters will be closed accordingly. Now, maybe the first one to be get covered under this, maybe the ENA, which has been brought out of the purview of GST. So whether the government will ensure that the past cases are cleared as and where basis. Second is the ongoing issue in the film industry, wherein up to the period up to 21, whether the film rights, etc., distributors, etc., whether it was at 12% or 18%. After 21 October, the rates have been 18%. So this 6% differential is a huge amount for the entire film industry, producers, distributors. So whether this kind of disputes, wherein the government is empowered to waive the recovery, because that was a trade practice, prevalent practice, and it was not one person doing it, it was the entire industry doing it. So whether all these scenarios will get covered out here. Another important amendment is to provide clarity on time of supply of services where the invoice is required to be issued by the recipient. So wherein it has been clarified, the invoice will also have to be issued within a specified period which will be notified. Some of the interesting amendments which are to settle old pending disputes, etc. Also 16.4, wherein one was not allowed to take ITC of a particular year beyond the November of earlier September and then later November of subsequent year. So there were delays in filing returns, claiming credits, etc. And the department had been disallowing the credits for ITC for lots of SSAs on the presumption that you are covered under 16.4 and hence you have exceeded the stipulated time limit to claim the credit and the credit will not be allowed. So there were judgments of M Trade Links, Kerala High Court, Rashmikant Kundra, Mumbai High Court, etc., wherein one used to say that if I've paid the late filing fees, my delays are regularized, etc. However, to settle all pending matters, at least for the initial 4 years of GST, from July 2017 to March 21, any ITC claim for any year before 30th November 2021, the ITC claim will be allowed. This will reduce a lot of litigations for a lot of and give a lot of relief to many SSCs. Sorry. Another subsection is being introduced under section 16, wherein the cancellation of the GST registrations is a issue faced by many SSCs due to various factors. Now, what was happening was the ITC that was clear, that was eligible during the period from the date of cancellation to the date of revocation of order. Now, what happens to that ITC? So it has been very well clarified under section 16 that if the returns are filed up to 30th November of the preceding of the subsequent financial year or within 30 days from the date of revocation, then the SSC will be entitled to the said ITC. This is also a very welcome move because substantial litigations wherein SSC could not file his returns or claim ITC due to the cancellation of registrations. This will benefit them in a way. Next slide, please. Proviso is inserted in section 30 to include conditions and restrictions on the revocation of registration cancellation. So here, this proviso has been inserted to notify rules which will be notified in due course for conditions and restrictions. As of date, there are no conditions restricted. There are very few, but they have been loosely followed. Strict conditions will be given out here. In case of TDS returns, it was to be filed only if there was a deduction during the month, GST TDS. Now, whether there is any deduction or no deduction, a person has to file his TDS returns. One of the good news out there is pre-deposit of filing an appeal with the appellate tribunal. The appellate tribunal is the SISTET, that means which has still not been formed. Was earlier the higher limit was 25 crores under additional 25 crores under respective act, CGST 25, SGST 25 crores. Now that limit has been brought down to 20 crores. And further, today while filing the first appeal, there is a pre-deposit of 10% of tax. And while filing appeal with the appellate authority, there was additional 20% to be paid. Now this 20% has been reduced to 10%. This will give a lot of relief to the SSEs and mitigate hardship due to cash flow issues. Another thing one has to keep in mind is tribunals have not, appellate authorities have not, appellate tribunals have not been formed as of date. But by the circular in after the GST Council meeting, it has been notified that the amount of pre-deposit, that is 10%, will have to be deposited now. So your appeal may take another, tribunal may take any time to get formed, maybe it's 3 months, 6 months. But this pre-deposit of balance 10% will have to be paid immediately. Further, since the appellate tribunal has not been formed, the time limit has been 3 months or date to be notified by the government, whichever is later. Another one of the important change amendment is in transitional. Now still, if one can imagine the disputes that have been going on, transitional credits means the credits which were passed on from the erstwhile service tax, VAT, excise, service tax rules to the new regime. So it has been clarified that for an input service distributor, the invoice, if they are received before or after the appointed date, the said credit can be transferred. Now that's a great relief because there have been various judgments which have gone up to Supreme Court on the eligibility of such credits. This should settle such disputes which were sent from Supreme Court back to the respective jurisdictional High Court for re-verification. Excuse me. One of the important amendments is a insertion of section 128A. A very welcome amendment to settle all disputes for the period July 2017 to March 2020. The main condition is if an order has been passed under 73, that is non-fraud cases, for tax, interest and penalty for this 3 years. And if an SSE opts to make the payment of tax, the interest and penalty will be waived off. Now, this is applicable only for the period July 2017 to March 2020. It does not cover cases after April 20 if any notices have been issued. Now, another thing is for those who have already paid the interest and penalty prior to these amendments, no refund will be granted. Now, which cases will get covered out here? Section 73. Show cause issued, but no order received. Order received, but pending before CCE appeals. CCE appeals order passed, but not filed before appellate authorities as tribunal is not formed. And fourth, 74. Orders were earlier issued under 74, but by way of a writ or by appeal proceedings, the authorities have held that the case cannot be covered under 74 and it needs to be covered under 73. This case is eligible for amnesty under the under section 128A of the Act. So by paying the normal tax demand, one can get a waiver of interest and penalty considering the hardships which were there at the initial phase of GST. Next slide, please. Another the welcome change is sunset clause for anti-profiteering authorities, anti-profiteering cases. So anti-profiteering was earlier established to ensure that the benefit of tax once shifting to GST is passed on to the consumers. And in case of any defaults, case could be registered with the anti-profiteering. The condition was the trade should not benefit from the tax differential. The benefit has to be passed on to the consumers. So now, after 7 to 8 years, now there is going to be a sunset clause, and some of the cases where will be transferred to the appellate tribunal, which will be designated by the government. Now, one more change, as we mentioned in the 53rd GST Council. Yeah.
Parag bhai, just in view of the time, if we can complete in 1 or 2 minutes, if it is okay.
Yeah, sure.
We
sure.
can keep some time for questions,
Sure.
and they
sure.
can ask questions. Yeah.
Sure. So two things. Settling the insurance disputes of reinsurance and co-insurance. If one party has paid the GST, then the reinsurer or the co-insurer need not pay the GST. So this has been introduced in Schedule 3 as not a supply at all. Second thing is summons were being issued to directors, CFOs, directors, etc. to appear before the investing agencies. However, now authorized representatives can appear on their behalf. This should give a lot of benefit to the people, relief. And Section 73 and 74 are now restricted only for the financial year 23 up to 23-24. And now all cases will be covered under from 24-25 will be covered under 74A. The time limit for fraud and non-fraud cases will be the same. That is the next slide, please. The notice, next slide. Next slide. The notice has to be issued within 42 months from the due date of filing annual return in both fraud, non-fraud cases. Time limit for issuance of order, 54 months from the due date of filing, may be extended for 6 months if approved. So here, the normal fraud cases, the time limit has to come down to by 6 months. And while in case of non-fraud cases, the time limit has gone up to another 18 months. So I think so this was it, what we can cover for GST. I'll hand it over to Uday bhai.
I think we did what we did and request Arun to maybe take over and ask questions. Next time when we have comprehensive review, Arun, I think we'll have to keep twice the time of what you have given to us this time. But anyway, over to you right now. Arun, you're mute.
Yeah, we've had quite a few messages here. We have a lot of questions, but some messages saying that it's a wonderful presentation, including one from Jignesh Desai. The direct tax presentation was very explained. I'm sure the indirect tax coverage also is equally interesting. A lot of people have asked for the presentation. We are coordinating with all our collaborating partners to see to it that we will maybe put up all the presentations on the Taxsutra portal for all of you to access at your convenience. Yeah, a super presentation, says Raghunathan. Oh, some of them are saying we'll have to log out due to time constraint. Oh, what do we do? The finance minister has a full year to prepare the budget. So yes, a lot of action for sure. Yeah. Uday, how many questions can we take? There are around 20 questions.
We are okay to spend as much time, but I just considering people's time, we just want to make sure that we do it. Next time, give us twice the time. That's what the only request I have.
Sure, Uday, sure. The first question.
Ask any important question, you take it up. What we could do is any unanswered, we can even later answer it by email.
We will. The first question is from Chetan Kakaria, is a good friend. Buyback whether non-resident shareholder would be better off due to possibility of net taxation as capital gains.
Yeah, so depending on now the tax would be, even if it is a non-resident, it will be in the new scheme, I'm just saying it. It will be taxed in the hands of a shareholder, right? So it will be a dividend. And dividend tax in case of of course, under the Income Tax Act is 20% withholding, but under the tax treaty, the dividend can be reduced to 15% under most of the tax treaties. If it was Mauritius, I think comes back to me after so many years, it is still withholding tax is 5%. I'm just my initial reaction on this. So definitely for a non-resident, the dividend tax is far more favorable compared to a resident shareholder because of the access to the tax treaty that can be taken. As I said, one would have to see the definition, but surely max dividend rate is 20%, I would say. 15 under most of the tax treaties, Mauritius is 5%. So yes, beneficial to a non-resident shareholder. Of course, one would have to see the tax impact in the home country. Sometimes the benefit which is given away may be taxed. It is in the US, I think foreign dividend is not taxable. So yeah, you may be beneficial if it was going through Mauritius, which I've seen a lot of projects. The money stops at Mauritius level and gets used somewhere else. Surely beneficial for a non-resident.
Shubham Khaitan, whether treaty benefits can be availed for buyback done after 1st October.
Which is what I said, right? Because now post that it will be treated as a dividend. So surely a treaty benefit can be obtained. Section 90 subsection 2, treaty or domestic law, whichever is more beneficial. Same thing is happening even after the abolition of DDT today.
Okay.
So you are getting a benefit under the treaty. Surely it can be.
And Vaidyanathan, TDS under 194T, remuneration is generally determined at the end of the year based on profit earned by partnership firm, whether drawings of a partner on monthly basis is liable to TDS.
Krishna, you want to take up this?
Yeah,
This is a new question which has come up since last 24 hours, I can tell you. Yes. Yes,
So
Krishna.
if you look at the 194T, which is a new provision which is introduced, it reads very similar to the TDS provisions, whether it is a commission or brokerage. It says on payment or credit, whichever is earlier. But if you look at the question being asked, they are looking at disbursement or whatever, like if it is being called as withdrawals, drawings, as compared to the TDS is applicable on the income. So whether it is in the nature of interest or salary, which is being credited. So it is not so much on the disbursal happening, unless like you are saying that I'm paying the salary or I'm paying so and so amount to the employee, and therefore if it is salary being paid, yes, it applies on the day on which the salary is being paid or the interest is being paid. Or if it is being accounted for in the books prior to the payment, then the date of payment will precede and therefore TDS applies on the prior date. And why I say so is because if you look at disbursal as a TDS mechanism, say for instance, the firm applies for a loan and then the partners withdraw it for whatever reasons, then effectively there's no income that the partners are getting. And purely on drawings, you could not have the incidence of TDS. So it goes back to the date of credit or payment, whichever is earlier, in relation to salary, interest, or salary or typically interest, because profit also would not have been covered.
Well taken, Krishna. We'll go to the next one. Puneet Daftari asked this question, and Puneet's question is on OFS. He says, in the context of OFS, the amendment with respect to fair market value is applicable retrospectively from April 2018. Hence, the OFS already concluded in the last 5 years would be covered. Would the capital gains be reported by shareholders in ITR for FY25? Also, there seems to be no interest levy on such past capital gains. Is this understanding correct? I just vaguely remember, I was on a business channel and I vaguely remember reading this section. It seems to me that the explanatory memorandum to this amendments suggests that this was supposed to be the case and people have supposedly gamed this provision and benefited. So you think possibly the department would have other options as well, maybe reopening, reassess, and so on and so forth, apart from this, whatever?
It would be, no, it would be. Actually, it is more clarificatory and department believes this is not a retrospective amendment. As I think if you remember, I just mentioned that some of those taxpayers took a call, SSCs took a call that, oh yes, of course, I knew the sale consideration, but I didn't know what was the cost of acquisition. I knew cost of acquisition, but the index cost of acquisition was not known. And so the formula failed. So competition mechanism failed, and that's why it was not subject to tax. And now they have simply clarified to say that this is the situation. The taxability, I would still believe, is on a transfer of a capital asset. So the transfer of capital asset took place in those years. So there would be reopening to the extent possible, 3 years, 6 years, whatever the time limit could be. It would be even today, right? And the reopening will take place, and the tax would be, in my view, levied in that year in which the transfer took place, when it was OFS happened at that point of time. And in addition, interest penalty, maybe one could, argue to say that yes, computation mechanism failed, and that's why I took that based on BC University. But surely tax and interest would be payable from that year, according to me. And reopening will take place.
Ankita Chadda asks, buyback governed by court order is not covered under section 222F. So would that be taxable as capital gain? I'm just trying to think aloud. Buyback governed by a court order, as in buyback
Like,
is the company.
no, buyback can be governed under 68, which is buyback under the normal buyback scheme. And there people have also done this restructuring in different manner. It was like, I don't remember the 2013 section. I remember 56 definitely, section 100, reduction of capital. So you could do a reduction of capital also. Now, whether that is not governed under section 68 of the Companies Act, there's a different section to reduction of capital under the Companies Act 2013. So technically, only buyback impacted under section 68 is covered under the new regulation. This has also been the case for reverse when there is an India outbound. I'm just giving a parallel analogy. The India outbound story, Indian company has a wholly owned subsidiary in USA. And you are doing a buyback of the US company shares. That's not a buyback under the section 68 of Companies Act 2013. That's for the buyback law of USA. And the view is always that it was not governed under 46A or under that exemption of 222. So some similar analogy will apply, but this is head splitting. But technically, yes, speaking, only if it's a buyback under 68, then the new law applies. Sure. If not, then you go under the normal litigation that is even prevalent today for the foreign company buybacks.
Okay, so it says Rupali Gupta is asking the question, I think you've answered, whether the provision will apply to buyback of shares of foreign companies.
It doesn't apply. But anyway, buyback we have done a couple of large engagements in this. It's an interesting issue. Say US company shares are being bought. USA in the past says, you don't care whether it is capital gains or not, it is a normal dividend. We will do a total withholding as per the dividend to the extent there was an accumulated profit. So it is taxed as dividend prior to this change. And it is taxed as a capital gains in India, if at all. Because it is not covered under 68. It could create a different class of income. It could create a tax withholding, foreign tax credit issue, and so on and so forth. So you may end up becoming in a larger problem. If to the extent you say dividend and dividend, no issue. Whatever tax paid overseas is allowed as a credit. If it is dividend in USA and capital gains in India, because 68 does not apply, which technically is the case, then it could be a foreign tax credit issue also under Rule 128.
Plus, you have the cognizant sword hanging over.
That's true.
There is a recharacterization.
Absolutely. This is a new cognizance just in an interim, as I said. That happened between, I can tell you, first March 2013 and 1st June 2013. It happened in May of 2013 to the best of my memory. Now the buyback will happen now. The cognizant 2.0.
Sandeep Mukherjee asks in the Vivad Se Vishwas, what is meant by, into inverted comma, appeals proceeding state before after 31/1/20? Is it the date of filing the appeal or otherwise? 31/1/24 it should be. I don't think it should be 31/1.
I think it is 20. I think. No, it is 20. I think. Yeah. Krishna, you want to answer this or? Krishna, you're mute. So that's an appeal file. They put a cutoff date actually.
Got it.
Yeah, I think it was there in the VVS 1.0 also, something similar.
Yeah.
But they were accepting it. I know that, at least in the practical, I remember it was 2-3 years back, that if the order was received later, they were allowing the appeal to be filed. I know that. So maybe something similar will happen this time also. There is a precedent on this.
Yeah, I'm just trying. We have time for one or two questions. Which one? Sumit asked this question. How do we determine residential house in case of a builder developer whose intention is to lease out property?
Sorry, I didn't get. Builder, developer means you bought your own house, right? Or it is leased.
It's not clear.
I didn't get a question.
How do we define residential house? I think he's asking that question again. How do we define residential house in case of a builder developer whose intention is to lease out property? Will it be taxable?
Doesn't matter. No? If you are owning a residential house, that is what is important, right?
Yeah.
What you're owning the residential house as per 54 F, a dwelling unit is important. Then whether you lease out or not is not relevant in my view.
Okay, fine. Priyanka Limay, and this is the last question that we'll take. We run out of time, sorry. In the context of buyback, you did mention that there is a need for further analysis, especially since buyback concept is included within the definition of dividend under Income Tax Act. Do you foresee a situation that buyback transactions could lead to categorization issues, especially for certain DTAs, and such buybacks could categorize as capital gains, given that they are essentially alienation of shares? Yeah.
No, so buyback is, I think there are a prior question we answered. Buyback as understood under section 68 of the Companies Act is covered. So if it is not a buyback under 68, this change is not, does not apply technically. So what you said about the reduction of capital or a foreign company buyback, to that extent, there are judicial precedents also which support it in the past. That only if it was a buyback in the past under 77A of the Companies Act 1956 or now 68 of the Companies Act 2013, then this change applies, not otherwise.
Yeah, because otherwise, in many ways, Uday Ved, this is deeming it to be a dividend. You're calling it dividend when it is not so, right?
No, but memorandum does say that.
And the memorandum goes on to say this is actually extinguishment.
Does exactly memorandum does say that. That's why 222F. That's exactly the intention. So now see, substance over form is going to be important going forward.
So for all practical purpose, Uday Ved, this is an extinguishment whose tax treatment is that of a dividend.
But I would say I would go one step further. Independent of this change, you could be questioned under GAR today. You have GAR, where it could be recharacterized. This is nothing but a dividend. Only because you said it's capital gains, no. So GAR is now already all pervasive. Of course, it will apply to larger transactions and everything.
But Uday, tell me that if the purpose is to recharacterize, then you may not as well have the buyback provision in the Companies Act. So I think we have to somewhere distinguish. You have the Companies Act, which is what gives authority to a company to a buyback, right? And if you're fulfilling those provisions of the Companies Act, then you're coming to the income tax side for the tax treatment. And on the tax treatment, the government has done a lot of flip-flops. You've said we'll tax it in the hands of shareholder, then said we'll tax it in the hands of company. Then you said we'll levy a DDT. Then we said that no, I will tax dividend in the hands of shareholder. Now you're coming back and saying, I want to bring parity with dividend. But then you're bringing it not to bring parity. The amendment is categorized under the head of anti-avoidance.
Yeah.
If you want to bring parity, DDT or dividend was not done because it was an anti-avoidance provision. Then why are you saying that buyback is because I want to deepen the tax base and anti-avoidance? You're categorizing it under the heading deepening of tax base and anti-avoidance. Why are you categorizing it as anti-avoidance when in fact the Companies Act provides a mechanism for buyback?
Yeah, no, you are right. It does provide.
Do buyback, right? Buyback is done globally.
Generally buyback is done when there is a cash trap for some reason. You do buyback because of that reason. Otherwise, you normally give a dividend. That's what government is saying. In fact, it goes against what is.
You a practical insight from a unlisted company point of view, and that is that it's going to create a lot of problem to return money to shareholders. And this is not about Indian company or foreign company, but if you're looking to return money to a shareholder, you have now tied it's like saying that I'll tie one leg of a horse and then say that, okay, now you run. Oh, it's not easy. So
No, it's
when
one more point I'll put.
earning
I'll
money
one
to
more
share,
point.
it's not going to be easy.
No, I'm just saying to support what you are saying. You look at FAQ number 3 of GAR. Essentially says the way transaction is structured is the prerogative of a taxpayer. GAR cannot apply. I'm just saying, taking that analogy, if buyback is permitted as per the Companies Act, and I'm doing it, and if it's a genuine buyback, right, then it should be go under buyback. Now you're doing a flip-flop. You're right. They did it in DDT also. Back to the shareholders, and now you're saying this is nothing but the US law, I'm just saying, treats it as same. No capital gain, no dividend, same tax. Here, because there is a delta of 23% versus 35 today. So there is a 12% delta. And now you are saying substance over form will, and this is anti-avoidance provision, right? So it would be interpreted in that. I'm saying it's a SAR. Accordingly, it's a SAR.
Just to give some sort of I'm now trying to step into the draftsman's shoes. Not easy at all. But look at it this way, that all the big companies where promoter holding is more than 68-70%, 74% is the threshold. If you are a listed entity, under SEBI rules, you need a minimum public shareholding, which is, I think, 25%. So you need 74% promoter shareholding cannot be exceeded. Now, a lot of these large corporate giants, which have 68-70% shareholding of promoters, have been doing buybacks almost year on year. And maybe they are doing it for group expansion for various reasons. But buyback is now a popular tool to send money back from the profit-making company to the holding company, which is possibly the group holding company, and which they use to expand, or maybe they use it for some particular purpose within the group. Now, essentially, in all these cases, the buyback has been taxed at 22%. It has not been taxed in the hands of the recipient shareholder.
Correct.
The government could have said that instead of doing all this, upar niche, they could have just said that we'll tax the buyback at 25% or 30% straight, instead of saying that I want to deem it as dividend, but you will have to claim it as a capital loss. So it creates an important timing difference. And when the timing difference is there, you also have the interest rate differential. What about the foregone interest on that money?
And that capital loss could be hypothetical. No, capital loss also could.
This is not
capital loss also could be hypothetical, right? Because only when you have capital gain, you will be able to set it off. So today it is gone.
No, you'll need another tax planning avenue. Uday, you have to create a capital gain. You'll have to, then if you're doing you may as well have a capital gain.
Yes, that's true.
Yeah. So anyway, but this is we can conjure up a lot of such
subject to Telangana High Court, I'm saying. Other than Telangana, don't create capital. Anyway, that's a separate topic by itself.
Pooja asks the question: will this be applicable to capital reduction as well?
No, and the answer that is, I think we just mentioned, because technically it applies to only buyback as defined under 68. I don't remember the capital reduction section under 2013.
But the feeling is that even now even there are divergent views on whether capital reduction through the NCLT route will it be taxed in the hands of the company as a buyback or in the hands of the recipient. There are divergent views on this, and I don't think there is a
but capital reduction will not.
High Court order.
No, I'll just tell you what will happen if it's a capital reduction. Won't be covered under 222F, but it governs under 222D straight away. 222D of deemed dividend. To the extent there is an accumulated profit, it is taxed as a deemed dividend. There are again judicial precedents to support this. So capital reduction may not go untaxed.
This one is for Parag Bhai. Rahul Gupta asks, in case of amendment under 16.6, ITC would not reflect in 2A of the taxpayer whose registration has been cancelled for the cancelled period. How does the taxpayer then claim ITC?
So in this case, I agree there would be practical issues out here to claim the credit, but the taxpayer will have to claim the credit based on the invoices that are available with him. And as done today, maybe one of the options is done today for the prior years, wherein a certificate from the vendor suffices to claim the ITC as per circular. The same route will have to be followed.
The very last question is the most expansive question of the day. What is your expectation from the income tax revamp in the next 6 months? Before that, there are some questions on Pillar 2. 4 or 5 questions on Pillar 2 as to why it's not come. You want to take that up, Uday Bhai, on Pillar 2?
So I think your question and answer both have answered that. My expectation would be certainly Pillar 1 and Pillar 2 coming as a part of the larger income tax revamp, which will happen. Okay, should come. And as I said, Finance Minister did say yesterday that withdrawal of equalization levy is a step towards implementing Pillar 1 and Pillar 2. Pillar 1 amount A mandatory, but amount B and Pillar 2 is not mandatory. So that's one step. The second thing which could come up in the revamp is this entire, see, today you have Section 47, which gives you the exemption for mergers, demergers happening in India. But today now RBI permits the cross-border merger. So a foreign company can be merged into Indian company under 232, 234, 232 of the Companies Act, as well as an Indian company technically can merge into a foreign company. Both inbound and outbound mergers are permitted. But when the Section 47 exempts today a cross-border merger if the merged entity or amalgamated entity is an Indian company. If there is and we are seeing this in recently, you would have seen in flip and the reverse flip structures, which are going on right now, whereas company had moved the residents overseas, right? And now you want to move it back to India because of the Indian capital market gives better valuation. We are seeing a reverse flip. There are these issues in terms of the exemption. So the cross-border merger part was never envisaged 60 years back. So one could see some of those kind of questions. There could be one exit tax. You have an exit tax in the form of transfer pricing today, but there is no exit tax when people are moving the residence today. Country like USA does have a formal exit tax. So it will be aligned more to the international community, cross-border trade. Pillar 1, Pillar 2 starts surely compliant with transfer pricing regulations. What else? I think, unless you say there is a book profit tax from the direct tax bill 2009, pay 2%, and then that's an end of the discussion. I don't think that will come through. I think there have been reports which have been published recently. Could this be consolidated into a larger direct tax code? Would there be a inheritance tax back, come in, or wealth tax could come in? All those questions will come up. But surely moving of residents, I think, is one part which may come, because a lot of people have moved the residents to Dubai as an example. You have 61A, but still exit tax is one thing which has not been covered. The entire definition of residence itself is undergoing a change globally.
I think you're going to have a lot of amendments to in the provisions which are litigative, because that's where look at reassessment, look at some of these other provisions. They have acquired a life of their own. And reassessments, if the writ courts are going to be clogged by reassessment cases day in and day out, you look at a high court like Bombay High Court, you are rarely seeing any final disposal matters. Cases filed, from ITAT, cases filed as far back as 15, 20 years are not coming up for hearing. You look at a set satellite, a 16, 17 years back, the Bombay High Court judgment came, and then in the Supreme Court, we still don't have a final hearing.
Yes. So important point on a litigation, either you already in litigation, you want to close it. There is no way to do it today, right? Till it goes to Supreme Court. Would there be some mechanism to close litigation? A formal negotiated tax settlement? Not thought. Or to kill the litigation. There is already an advance ruling today possible. for non-resident, there is an APA possible for transfer pricing. Would there be advance ruling for residents? That could kill the litigation. Two ways to do it. Those are some kind of things if you want to make it easy and reduce litigation, or you'll have to keep on coming back with this litigation story. There's a department, most of the department, tribunal, more than 90% is lost by tax department. So the huge amount of time, effort, everything goes, you're right. So anything to kill litigation and to stop litigation before it occurs. Those are the kind of things it could come in. And one more thing, I also said it in a few forums. I don't know whether in order to, because the finance minister did say we'll make it lucid and simple to understand, read, whatever. In a advanced world like USA, you have an income tax act or IRS, but there is a huge amount of commentary to say this is intention of the legislature. Now you want to get into litigation, do it outside. Otherwise, 90% of the litigation can be stopped by being in that forum. Would something like that, we have seen it to an extent of GAR FAQs or poem FAQs, but we are not seeing anything on that kind of a commentary which could come in, and maybe would there be a shift in the mindset of the tax legislature to say, okay, guidelines on important sections, right? Those are the things which can, stop litigation from happening. So two things. One is to kill or stop litigation for the existing litigation cases through negotiated settlement. I'm just just thought nothing of that may come in, right? And would there be a tax consolidation? That's some question somewhere was asked. Would India go into a tax consolidation? Never been spoken about it. We have a book consolidation, but not tax consolidation.
Yeah, I think maybe the finance minister can start with the low-hanging fruits.
Yes.
The larger question that still will remain is you want to make it easy to understand, lucid, easy to read. Now, even if you do all of that, the disposal timeline, if at High Court and Supreme Court for old cases is 15 years to begin with, I think quite honestly, whatever we do, maybe the fruits will still be seen after 15 years when the old pileup gets reduced. But look at GST. Someone asked me how many GST cases do we have in 6 years, and this is without an appellate tribunal being notified. We already have over 7,000 cases in our GST database at all. Over 7,000 cases already on GST, and the writ courts are again being clogged for issues like registration of cancellation. Someone even asked a question here. So we said GST would be one nation, one market. Okay, if not one tax, one rate, but one nation, one market, one tax. And just see, we should have added one nation, one market, one tax, record litigations. So we can add easy to read, easy to understand, lucid, plus litigations. Argumentative Indian. That's, I think, a book which I think one of the Nobel laureates wrote, Argumentative Indian. So we'll keep it at that. And should we wind up with that, Uday Bhai, Hetav, Krishna, Chanchal, Parag Bhai, wonderful session today. A great participation, so many questions. Forgive us if we couldn't answer all of them. We tried our best to come up to your expectations and answer as many as we could, time permitting. It's already past the 2 hour mark. So we've also made a record, and that is that this is the longest budget webinar that we've had in the last 5 to 6 years, at least. Uday Bhai, many thanks for joining in from Dallas. It's I think it must be around 1:30 now, your time. So you must catch up on sleep. You deserve a great night of sleep.
Thank you.
Yeah.
Thank you.
Yeah. Thanks.
Always a pleasure, Arun, to be with you, and we always enjoy that. So,
what a wonderful session! Thanks everyone for the patient hearing. Goodbye and have a wonderful week. Thank you.
Thanks to you, and to entire team and all the participants. Thank you for the opportunity.
Thank you so much.